Investing and trading are two common ways to make money in the financial markets, whether it's stocks, crypto, precious metals, or some other assets. While both involve buying and selling of assets, they differ significantly when it comes to strategy, time horizon, and risk tolerance. In this video, let's look at them side by side so you can decide what works better for you. Let's begin. Starting with the basic definitions. Investing at its core is a long-term wealth building strategy. This involves buying assets with the expectation of holding them over a long period of time, often years or even decades. Investors aim to benefit from the potential of these assets going up. Common investments include ETFs, stocks, bonds, real estate, and mutual funds. For a lot of us, this also includes Bitcoin, and let's throw in some other cryptos too. Trading, on the other hand, is a short-term strategy that involves buying and selling assets within a much shorter time frame. This can range from a few weeks going all the way down to a few seconds. Traders seek to benefit from market fluctuations both upwards and downwards using various techniques. Traders usually don't care about which stock or asset they trade as long as they make a profit. However, a lot of traders stick to markets they understand because the ups and downs in different markets can work differently. Now let's look at some types of investing and trading. Generally speaking, investing can be split into two categories. First, active investing. Investors who take an active investing approach monitor markets carefully and make regular adjustments to their portfolio whenever needed. Active investors generally seek out particular investments that try to mimic or outperform the returns of a specific benchmark index. Passive investors follow a buy and hold strategy. This type of investor does not make an effort to closely monitor the markets on a daily or even regular basis. ETF investing is the most common type of passive investing, with S&P 500 ETF being the most common due to the consistent growth it has shown over the decades. Currently sitting at over 10% annual returns over the decades, this one's hard to beat. But within active and passive investing, there can be different types too. Here are a few examples. Value investing. Value investors seek undervalued assets, focusing on factors like price to earnings ratio and intrinsic value to identify long-term growth potential. Warren Buffett is a famous proponent of this strategy. Some of his most famous value buys include Coca-Cola in the 1980s and IBM after the dot-com crash in the 2010s. Growth investing. Growth investors look for companies with the potential for substantial future growth when sacrificing current profitability for expansion and market dominance. Tech companies like Amazon and Tesla are prime examples of this over the last few years. Income investing. Income investors prioritize assets that generate regular income, such as dividend from stocks or interest from bonds. This strategy is popular among retirees and income-focused investors. So, investing comes in many forms, but what about trading? Yes, trading can also be categorized in many forms. Let's look at some. Day trading. Day traders open and close positions within the same trading day, aiming to profit from intraday price movements. Swing trading. Swing traders hold positions for several days to weeks, capitalizing on medium-term price trends. Scalping. Scalpers make dozens or even hundreds of small trades in a single day, seeking to profit from minimal price fluctuations. It's a high-frequency, high-risk approach. Finally, algorithmic trading. Algorithmic trading involves using computer programs to execute trading strategies automatically. It's popular with institutional investors and hedge funds. But with the dawn of AI, who knows where this is headed? So now we have a good understanding of the different types of trading and investing. But what does it take to be good at the two? The focus in investing is on fundamentals such as company financials, economic indicators, and market trends. Several metrics and a lot of information is required to make good decisions. Let's look at two common indicators. Price to earnings ratio. The PE ratio is probably the most often quoted ratio of all companies. Generally speaking, if you look up any stock, this ratio will be front and center. In short, this ratio tells you how many dollars you're paying per dollars of earnings. Similar to the PE ratio, earnings per share is another way of tracking how a company is doing. To find a company's EPS, you simply divide its earnings by the number of outstanding shares. There are several other balance sheet indicators that investors need to look at. Plus, don't forget about the brand and company's management. Trading, on the other hand, is done using various techniques such as chart patterns and technical analysis. Just to show you, let's look at two indicators that are easy to understand. Relative Strength Index. This tells you if an asset is overbought or oversold on a specific time frame. Then, Moving Average is a technical analysis tool that smooths out price data by creating a constantly updated average price. I have very limited technical trading experience. I've dabbled a bit in swing trading, but mostly based on macro factors and not really technical analysis. But I want to highlight that the number of indicators in the trading world are endless, and you will hear about way too many of them on social media and YouTube. But from what I've seen, some of the best traders use only handful of indicators to build their strategies. Now, we have a good understanding of what trading and investing are. Could you spot the similarities? Yes, the most important similarity is the goal with both, that is to make money. Both investors and traders want to make money, often using the same assets. And the other commonality is that both come with varying degrees of risk and reward. So what are the key differences? The biggest difference is the length of time traders and investors hold their assets. Also, the risk for traders is much higher than for investors. There are several ways to be wrong in trading and fewer ways to validate your thesis. While investing requires extensive research to validate your thesis, there's plenty of information out there to perform good research to validate whatever you're looking into or holding. Finally, I believe that trading requires far more experience than investing. Talking about that, let's look at the success rate. The definition of success that I'm using is, do you make money over the long term? Compared to trading, investing can be considered an almost sure shot way of making money. The success rate of investing is relatively high over the long run. Historically, the stock market has delivered an average annual return of around 8 to 10%, even factoring in market crashes and economic downturns. However, the success is contingent on factors such as diversification, time in the market, and a well thought out investment strategy. When you look at trading, it's inherently riskier with varying levels of success rates. Many inexperienced traders and beginners start losing money due to lack of experience and emotional decision making. This graphic by TradeSighty shows the reality. All traders start with get rich quick mentality. 40% stop after a month, 80% give up within 2 years. By the end of year 5, only 7% remain, and at the end, only 1% really make any money. Yes, I know what you're thinking. I am different. I can make money. And maybe you can, but it can take you almost a decade of consistent trading to figure out if you're good at it. Talking about that, let's look at the last topic in this video. But before that, if you are enjoying this video so far, hit like and consider subscribing to support my channel. Now I'm sure you're wondering, who is investing for and who is trading for? Investing is suitable for people with long-term financial goals like saving for retirement, a child's education, or wealth preservation. It's for those who have a patient approach and can withstand market fluctuations without panicking. Inexperienced people or individuals with low risk tolerance often find investing a more comfortable choice. Trading, on the other hand, is best suited for individuals who can dedicate substantial time to monitoring markets and executing trades. It appeals to those comfortable with short-term risks. Experienced traders often have the emotional discipline to make quick decisions under pressure and are not averse to the possibility of significant losses. Trading is also a choice for people who want to stay consistent and become good at it. It's better to treat it as a job than a way to invest. Investing and trading are different approaches to making money in the financial markets. Each comes with its unique goals, strategies, and risk levels. The choice between the two depends on your financial objectives, your risk levels, and how much time and effort you're willing to commit. Whatever you choose to do, remember, consistent learning is the key to winning. I mostly indulge in long-term investing with a time horizon of over 10 years, and from time to time I'll do a few swing trades. Comment below what your strategy looks like. We will look at more and more of these topics on this channel. Till then, keep learning and stay on top of your finances. Until next time.